All right, our first panel of the day, welcome. We look forward to the insights. We are so bold in designing this event. We're so comfortable that you've got three of the smartest people in the room that we've opened the first panel with compliance. Yeah? How bold is that? We're risk takers in Africa, and here is the example. You have your mics. You ready to go? All right. Over to you. You happy to roll with it, yeah?
When our moderator asks us a question, we're happy to roll.
All right. So let's kick off with let's just do the quick basics. 2 minutes each. What is your day job, and how does it fit into the private equity ecosystem? Please.
So I'm a tax partner at Bowman's. Bowman's is a law firm. I'm a chartered accountant by trade, so you should ask, what am I doing in a law firm? And somebody was reminding me this morning, the number of the law firms around, particularly in the M&A private equity space, have chartered accountants, which is interesting. You mentioned compliance, and tax compliance is an important aspect of our day-to-day operations, whether it's from an individual perspective or a corporate perspective, because compliance today, in terms of tax, is the start of what I see as potential tax litigation or dispute with the revenue service. So to get your tax compliance correct, to get disclosure correct, to take your particular tax positions correctly is the start of a process, or perhaps the end of a process in terms of which dispute resolution could arise. I spend a lot of time doing that in the law firm that I work for.
Excellent. Thanks. Shelley?
Hi. So yes, my name's Shelley. I work for the Southern African Venture Capital and Private Equity Association, sort of SAVCA. And my day job is head of regulatory affairs. And essentially what my job is to do is to spend, basically my whole life with regulators, trying to understand how they look at private equity, explaining the structures, and then really trying to advocate in terms of where the regulation needs to go from a South African perspective mostly, and how it needs to deal with private equity. So we spend a lot of time talking about, what benefits it is in terms of investing in private companies and attracting, growth rates in the real economy, and how the regulation can support that rather than restrict it in terms of over-compliance or over-regulatory burden, and trying to manage that balance or help them manage that balance in terms of not over-regulating, but also just supporting the industry.
Enoch, please introduce yourself.
Thank you. So my name is Enoch. I am part of the transaction tax team at EY. And my day job is really advising private equity funds on investments into sub-Saharan Africa as well as exits. And I think the focus really is on mitigation of tax risk on those inbound and outbound investments.
Excellent, thank you. Shelley, could you kick off with us and give us some context for what's happening in the regulatory space in South Africa, still pretty much the dominant market in terms of private equity, or certainly on the continent. Could you just give us a shape for what the regulatory landscape is looking like, and how you hope to influence it?
So currently, the regulatory landscape in South Africa is a little bit, for private equity at least, I'd call it haphazard. And the reason was that when our current regulation was designed, private equity was never considered. It wasn't specifically taken into account. It really was designed for the man in the street or general asset managers, people selling insurance policies, etc., to retail investors. And basically what happened is then the regulation came out, and from a private equity perspective, we tried to look through the regulation to actually work out, where do we fit, how does it all work? And the difficult part was that actually, because it doesn't fit, you could go to various law firms and they would each give you a different opinion as to, do you have to register? Do you not have to register?
Some would give better opinions than others.
Yes, and so I think, in essence, we've just got quite a broad range in terms of the regulation in South Africa. So what actually happened is the industry itself essentially decided where we thought we needed to be. So one was that the idea was that private equity should be regulated to attract international and local investors. And there's just essentially a category difference in terms of whether you don't have pension fund investors, so you're a category 1, which is called a non-discretionary fund manager, or a category 2, which is a discretionary fund manager. And broadly, you've got different obligations to comply with. So that's where we are. we also regulated by huge amounts of exemptions because obviously for liquidity requirements, things that the structures just don't allow for in the current regulation. So South Africa is going through what we call Twin Peaks, which is essentially as a result of the 2008 financial crisis, and it's relooking at all of its regulatory frameworks and how it's going to be regulated. The upside is that at least we're a lot more on the front foot now, and the idea is that we're actually sitting with the regulators to try and work out how we can best do it. Now, the current regulation is actually looking at the whole financial sector. So it's looking at banks, insurers, asset managers, etc. And that regulation is supposed to go across sector. So the idea is that it's based on what you do, not your legal entity form. So if a bank's going to do private equity or an insurer is going to do private equity, they should be regulated exactly the same no matter what institutional form they take. And they're trying to look at what the actual activity is that the private equity fund manager does. The difficult part, I guess, where we get to is that on reading the initial publication or the initial regulation, in a private equity structure, you can regulate the fund manager, the GP, and the fund itself. Now, from our perspective, the difficulty that comes with that is that, wow, imagine having 3 licenses for every single fund, and then if you've got multiple funds, how many licenses you're going to have for real no benefit. So a lot of it is about educating the regulators in terms of how the structures work, where the decision making sits, and how they can design or at least compensate in the regulation for the types of structures we have, but still addressing the risk. Because I guess, as we've mentioned, the idea that capital will flow where it feels safe. And if you're trying to attract new investors, specifically the pension funds, they want to know that you are regulated. And they want to know that actually they're taking their fiduciary role really seriously in terms of understanding that the risks have been addressed.
Any quick responses from the fellow panelists?
Yeah, just a quick point, Enoch, before you respond. It's interesting that your focus is to educate the regulators we deal with. The regulators I deal with are perhaps in a different league in terms of wanting to educate or not wanting to educate, particularly when it comes to issues like carry, which we'll touch on a bit later.
You know?
Yeah, I think the point that you mentioned around being able to, for the GP to be able to show that they've been able to address those risks from a tax perspective, that is certainly a key issue. And so with respect to, let's say, any tax risks that may be in the portfolio, that's something that is quite key for the GP to be able to demonstrate to the institutional investor.
Question at this time, want to jump in? Anyone? Quickly? We've got to keep moving quite quickly here, but if you've got something burning, please raise your hand and team will get you a mic. So how are these regulatory reforms relevant for the rest of the continent? Can we zoom out of just the South Africa focus for now? I'll start with you again, Shelley, yeah?
So in effect, what happens across the rest of the continent is that as South Africa's, the advanced financial market in the continent, we take our lead from the developed markets. So when our regulators look to develop regulation, they'll look what they're doing in the US, what are they doing specifically in the UK and Europe. And then, in essence, often the rest of the continent will at least to see how they are regulating in South Africa and then pick and choose what they do or don't like. Now, it's almost quite an interesting point because I think everybody's trying to grapple with the same sorts of things across the continent. So with private equity, in South Africa, we've obviously got a listed market that actually is very advanced, and the regulation around that is very well embedded and essentially world-class, albeit that we have had a couple of instances recently where we may question that. But in the rest of the continent, private equity actually forms quite a big role in terms of actually, if you don't have a listed space, well, actually the likes of pension funds, etc., are looking to the private markets. So what they're looking to do is to say, okay, well, the fund manager is located in those jurisdictions, but often the funds are domiciled in the likes of Mauritius or other places. So the question comes as to how do you regulate the fund manager, and specifically, how do you regulate based on who they sell to and why they're selling? So where you've got foreign fund managers, coming into a country, but the fund is not domiciled in that country. How do you protect the investors from that perspective? So I think that's what they're trying to grapple with, and specifically on the continent, because in South Africa, we still have a lot of funds that are almost parallel. So you'll have the South African investors in your South African fund, and you may have your international investors via Mauritius. So they've had to consider South African investors in a South African domiciled fund, but that's not necessarily always the case. With the international or with the rest of the continent. So I think the regulators are all looking to each other to sort of, and they do share and they do try and work out how best to actually look at it.
Enoch, could I get an opinion from you on the view, the tax view on some of the implications of that across border?
Yeah, so I think maybe just to set the scene. So from a tax perspective across the continent, I think there's been the usual issues that sort of drive the investments. So you have your issues around cash extraction, the usual concerns, if I can call them that. Cash extraction, tax uncertainty triggered by inconsistent application of the law. But I think the key thing that is driving, or the key considerations at this point for private equity really revolves around the changes that have been driven by the OECD through their sort of ongoing 6 to 7 year project on base erosion and profit shifting. So, and that touches on two fronts, which is A, it touches on the GP. There are a number of action points in there which apply to how the GP operates, especially where you have a global footprint of advisors. And then you also have the action points and redresses which apply to the portfolio companies. And things such as transfer pricing are key. Things such as permanent establishments triggering taxable presences in various jurisdictions. So it's then quite key for the GP as well as the portfolio companies, whether you are considering an entry or if it's an exit, to understand there is no tax risk that would crystallize and therefore erode investment returns as a result of these ever-changing laws that are now being adopted by the various countries off the heels of what the OECD is proposing.
Can I get a response, please, from Michael?
In terms of issues like taxation of benefits for fund managers, the rules from a South African point of view are relatively complex and sophisticated, not as sophisticated as and specific as some of the other countries, like the UK, like some of the Scandinavian countries when it comes to the taxation of carry. But within the rest of the continent, the rules are a lot less complex and a lot less understood by the tax authorities, by the regulators, particularly when it comes to aspects like carry. Concepts of remuneration and benefit and tax on benefits is a constant theme within the continent, and that's something we would look at from a fund manager perspective in terms of establishing the tax treatment of the likes of carry. In South Africa, it's a little bit more sophisticated, in fact, a lot more sophisticated in terms of our legislation, which is forever changing. But that's a key theme and a key thing that we look at. The other point I think you may have touched on, Enoch, is withholding taxes, or withholding taxes, which are an issue throughout the continent, and ensuring that you have the most favoured treaty network, whether it's out of South Africa, whether it's out of Mauritius, particularly when it comes to foreign investors investing in parallel type vehicles, is a critical theme of what we would look at on a regular basis.
Any questions from the audience? Check in very quickly. Any quick questions? So I've got kind of an obvious one. Maybe it's high level. Maybe you don't want to risk your career by answering, but we're risk takers here at this event. I was fascinated by the Economist podcast, which dealt with the case of Abraj and the impact that's had in the conversations I'm having in the US around investing in Africa through private capital. It's been a huge chilling effect, more than these tax issues. We can't have a panel on tax compliance and regulation without addressing what can we learn, what happens better next time. Yeah. So can I have a comment from each of the panelists on what's the learning? How would you turn around the chilled view of private equity execution in Africa coming off what happened in Abraj? Shelley, can we start with you?
I think with the barrage and where everybody's getting to at the moment is actually around corporate governance and what kind of split you have in terms of the risks that you actually have in a structure. So for me, I think, at least in South Africa, there's the amount of DD that people do on the actual operations. So I guess what we're talking about today, in terms of who can do what kind of authorities you have, do you have any kind of segregation of duties? And I think, in reality, often the managers or the people that are doing the deals and managing it have such full control over paying money away, what you do, etc. And where they're looking to go, and when we talk about what they've done in AIFMD, is they've really strengthened the governance around who can do what and who's responsible. So, for instance, we had a fund manager training program with fund accounting and things like that. And in the room in South Africa, we just asked the question, so who does your valuations of your portfolio companies? And essentially every team actually came back and said, it's the deal teams that do those valuations. Now, we know that actually everybody says it's cash to cash and nothing turns on the valuations, etc. So therefore, you're not incentivized to increase the valuations or that. But the idea that actually internationally they're looking to say, no, it actually has to be done by somebody that's not involved in the portfolio company. So that's a complete shift in terms of who does what and who takes ownership of that. And I think in South Africa, where we're going to end up trying to work out is that what kind of governance do we actually need in a fund, and do we almost need to have an internal best practice or an industry best practice? I don't necessarily think that it has to be regulated as such. So it's almost saying, as an industry, where do we think the major risks lie? Conflicts of interest, cash flows, things like that, and how do you actually manage those and put your own governance processes that actually you can't have the same failings happening again?
Enoch?
Yeah, I think touching on the point on regulation, it comes back again to the one of the action points in the BEPS project is around transparency. The base erosion and profit shifting project spearheaded by the OECD, one of the key aspects is transparency. And so in light of that, it will be quite clear that for whether you are a fund manager or whether you are the portfolio company, the reporting requirements that will be required will certainly reduce the risk, at least in my mind, in terms of the failings that would have happened, let's say, with the barrage. At least that's the perspective that I think would be.
Okay.
Yeah, I think the concept of governance and structures, even from a tax point of view, is something we're pushing very hard, certainly within our organisation, and also linked with the concept of symmetry within a private equity fund and its portfolio company. I mean, the question is, how often do we actually sit as fund managers with our portfolio company heads, perhaps with an external party like Bowman's moderating the discussion. But how often do we sit with them to talk about themes in terms of tax, for example, with confidentiality aside, themes across the portfolio company with the fund manager sitting in the organisation? It happens a lot outside the borders of our country. It should be happening a lot more within South Africa. I'll give you another example. How often, and those of you that have been involved in multi-billion rand leverage buyouts, how often have you had a query from the revenue authorities 5-6 years after the deal is closed? And then you look for the agreements, which are in a drawer in somebody's office. Some of the agreements are still in draft. You can't find a particular agreement. The agreement doesn't tie up to the financial statements. There's something in the financials that doesn't tie up properly to the tax return disclosure submission, the point I made right at the beginning. Why are we not considering that up front? We do the deal and ensure through the process that we have a governance structure whereby compliance in the context of tax follows through in terms of an audit trail type arrangement, as I say, from the agreement, resolutions, etc., i.e. all the documentation at closing to the financial statements, to the tax return. So when a query does arrive in 5 years' time and something is requested, the likelihood of everything being there is there. It's something that is important for me personally. It's something that we're pushing very hard within the industry, and I think it's just an aspect within the private equity phenomenon. We sit overseas, we're not seeing it here sufficiently. That should be thought about, at least, within South Africa.
Now, I'm going to ask the panel to pick up one of the threads that we have today. I began with how could we get more capital flowing into the real economy to work with the person selling candy on the sidewalk, the person sitting in the air-conditioned office. Harry was explaining to us what's happening in Africa in terms of capital markets and availability and how pension funds weren't really showing up. We have a situation of a bad actor, which has put a chill at some level in capital raising. I know it hasn't been a horrible year, but it hasn't been the best of years. What, from each of the panelists, could you offer us one view, one positive view from a tax regulation and compliance perspective on how can we put a barrage in the rearview mirror? How do you know right now one of your SAVCA members or one of your EY or Bowman's clients aren't the next barrage? Can you give us something positive that we can point to on how can you build back confidence that frankly had a bit of a Theranos/WeWork moment? Shelley.
So I think for me, the interesting part is we actually do quite a lot of, discussions with pension funds. We go to all their conferences to try and understand their environment and really just to piece the two together. So in South Africa, at least, I think they did a survey in 2017 based on the pension fund assets, and it's 0.3% is allocated to private equity of all pension fund assets. And if you look at the split, there's probably 10 to 15 pension funds that actually allocate to private equity. And as you said, nobody is near the cap. You may get one or two that are closer, but even the big ones actually are not particularly close. And I think from my perspective, when we talk to pension funds, one, they've got a very different view to the developed markets. When you talk to US pension funds versus South African pension funds, interestingly enough, when they're trying to match their assets and liabilities or how funded they are, in the US, they're all sitting at I think the average is 73% funded. And in South Africa, it's all over 100% funded. So the reality is they haven't had to look at riskier assets in South Africa because the listed market has given them great returns. So broadly, that's your starting point. But in reality, the listed markets also now had not such great returns, and in essence, they've also had their issues with the companies that are listed on the exchange, and the pension funds lost a lot of money. So they quite like the idea that there's this active management, that you have somebody sitting on the board. In essence, they're trying to get people to be more active. So I think the idea that capital allocators are looking to be able to say, okay, well, what more do you add? And we know that private equity does add a huge amount. And to show that actually you're improving the governance of the company that you're actually investing in, to be able to grow that company, create the jobs, and actually it comes down to impact. At the end of the day, if you can show what you're actually doing and that you're going into the real economy, and that actually you building a shopping center, but not in Sandton, where actually none of their members actually care because they don't live here and this is not their world. So if you actually try and tie it back to what really matters in their members' lives, well, that's one of those reasons where they will then start to try and ask questions, at least to their asset consultants and to the asset managers that manage most of their fund, to go, okay, you've invested in all these listed stocks, but what have they actually done for the members that actually I care about? And if you can create that link down to, I guess, the people that have to travel, for hours to try and find a hospital, things like that. Again, it's only a specific type of private equity, but in reality, if you're able to show that whole link, you're a lot more likely to get investors to actually allocate capital. And then you have to go to that section where they're saying, okay, well, how do I do due diligence on a fund manager? Never had to do it before. The asset consultants are not so sure necessarily how to do it either. So we're almost getting to a point where you actually have to say, well, what do we need in the fund managers to make sure that actually you can tick all the boxes to get these capital allocators to feel safe, that their capital is not going to end up with the likes of a barrage.
Can I just pick up on the point quickly, if you don't mind?
Sure.
I was on the pension. I also saw that stat. In one respect, I was very annoyed when I saw 0.3%, but in the other respect, it didn't surprise me. It's an industry for me that is not investing sufficiently from a South African point of view in the PE space. I think aspects like training, awareness. I mean, from a tax point of view, do you know what the tax rate of a pension fund is? 0. Okay, 0 on capital gains. So just from a tax perspective, why aren't pension funds doing enough? I think there's an education process, more of an education process required. Perhaps it's not the pension funds that we should be chatting to. Perhaps it's the pension fund administrators who advise the pension funds that we should get into a room like this and talk about aspects, whatever the aspects are. So I'm quite passionate about that particular area, but that particular industry. I mean, earlier this year, as an example to counter that, Shelley's organisation and ourselves, we did a session in Mshlanga where we brought private equity and family business together, another untapped market from a private equity perspective. And you've asked for good practical outcomes out of this event. For me, those are two industries that should be pushed extremely hard. It's a massive opportunity to bring private equity and family business together, and so with pension funds. But it's for me, it's about awareness, it's about training, it's about engaging, negotiating, and that's how we'll get somewhere. But that 0.3% is not acceptable.
Let me add to that. I like the example of the family-owned, and I hear you about pension funds. We've been batting this against pension funds for 20 years. None of this is surprising, right? We know how powerful the gatekeepers are at the asset consultants and so on. There might also be a vibe about people don't like the fact that all the PE shops are in Olovo or chilling in Mauritius while they're sweating trustee meeting every quarter, having to spend a day in some hot room. So there could be some kind of stuff that I don't fully understand. But I see work for Savka here. Those two items that you put out. So let's say by the second forum that we have next year, you would have had a paper on impact. I know you did one a while back, right? And a second one on engaging pension funds. And my encouragement to Bowman's, actually to all three analysts, to everyone in the room, check your own Provident Fund. Check your own pension fund. It's not them and us. It's we. We are the retirement industry. I would suggest, based on your bonuses, you might have larger influence than maybe 1,000 blue-collar workers who clean Sandton City. I could be wrong. I don't know what your bonus structure is like. I'm assuming. So let's make it very direct. For Enoch, for Michael, for Shelley, how can you convince yourselves, if you're making your own allocations, or the trustee boards of the entity sponsor of the retirement fund structure sponsored by your own organization, how can we go to EY, how can we go to Bowman, how we can go to Savka's Provident structure or pension fund structure and say, guys, let's find that 10% limit and let's go live at the limit. Enoch, how can you do that in the next 364 days?
Well, just given the simple tax advisor I am, I hadn't given it much thought, but that's an interesting one. I mean, if we were to have a second forum, I would be keen to share my thoughts on it.
Excellent.
Yeah.
All right. Is everyone tweeting this live? It works best if there's that accountability mechanism, right? And I'm looking at all of you too. Just these three talented people are up there for the moment. Shelley, how will Savka be a 10% allocation in your retirement fund in 364 days?
So we don't have a retirement fund. That's nice and simple.
Oh boy. Oh boy. Would a financial planner please step forward and help the lady from the room? Oh boy.
Savka itself doesn't actually have one, but obviously in our own right, yes, I guess it's to ask the question with our own pension funds or where we allocate.
Good.
Yes.
So you'll be the heartwarming personal finance story interviewed by Bruce Whitfield in 364 days. Excellent. Michael.
Well, as lawyers, we don't take risks. So together, Shelley, we're going to have a combined pension fund administrator discussion with the industry to talk about opportunities, because there are only so many pension funds in the country, and to ensure that 0.3%, which is the same percentage as hedge funds, in terms of hedge funds, the same percentage allocation to pension funds as private equity, which makes completely no sense to me. That we do something together, and finally, and I looked after private equity in a previous employer that I was for a number of years, and that was something we were going to do there. We didn't do because I decided to leave, but it's something we need to do. We need to engage, and for me, that is the only way. We are looking at some interesting tax attributes in terms of pension funds, and how we can make it sweeter from a pension fund perspective when it comes to tax. I'm not giving any secrets away, but that's something we're looking at because we're taking it extremely seriously within our firm.
Excellent. Last call for questions. Any questions? Sure. Do we have a mic for the question? Please. Please just introduce yourself and jump to the question.
So I'm Paul from SS&C Advent, and we specialise in fund accounting software, also on the PE side. But this was to you, Shelley. you talked about fund accounting training and segregation from the deal makers. Are you seeing a move towards outsourcing the fund accounting function here in South Africa, or is that just beginning?
I think there's a bit of a split in terms of the outsourcing versus non. So I think a lot of it comes down to cost. So I think what people fail to understand is actually, even though majority of the fund managers, at least in South Africa, are really small staff, and I guess even their funds under management, so the entire industry is only 170 billion rand. So in essence, to have a fund that's big enough to outsource, then yes, then it definitely does happen. I think because all the fund accounting and all the systems that they run on are often charged in foreign currency, it makes it cost prohibitive. So what we actually said to the people in the room is, if you're looking at attracting more people to outsource, then find a cost-effective package that actually can beat Excel but do everything that you can, and make it that there's a benefit for the fund manager to actually do that. So on the regulation side, there's obviously the administration and the question whether those administrators will need to be regulated going forward. There's always the outstanding question as to what service level agreements do you have, how do you actually manage that. I don't think the regulators necessarily got their heads around that, but it is something that happens in the hedge fund space in terms of who does what and how do you, if you meet one of the activities that's listed in the space, then there's a question whether it would need to be, but often the fund administrators are outside of that loop because the fund manager still takes responsibility. So if you're going to do that, just make sure that you make their life easier and that they can take responsibility and know that it's being done correctly.
Shirley, building on that, why doesn't SAVCA produce with your members model contracts or model SLAs like you pointed to?
Put us out of business.
You can throw your logo on it and update it every third year or something.
So we have actually asked the question, and the feedback we got, we obviously can't draft them ourselves, is that it's actually finding people or law firms that will help you do it and that you can actually have some value with it. In South Africa, I guess there's supposed to be tweaks with every single legal agreement, and I guess that's the IP that they're selling. So if you find us a law firm that will help us draft, then maybe we can have the conversation.
Excellent.
On a more serious note, on the tax accounting side, we do see a number of our clients in the fund manager space asking us to assist with the accounting of profit distributions and distributions out of the fund in terms of GPs entitlements and carry entitlements, because it does get complex. It's easy at the beginning because there's nothing, but as the years go by, the allocation of the distributions among the legal nature of the distributions that come out, capital gains, interest, dividends, become a lot more complex when you start applying the waterfall feature in terms of those allocations. So we are seeing a lot more of that as opposed to the accounting as assistance. And yes, we'd be happy to work with you in terms of the other question.
Excellent. Each of my panelists, starting with you, Enoch, could you give us 60 seconds your last thought that you want to leave the audience with?
Yeah, I think there is. I know there's a whole bunch of doom and gloom sometimes, which is painted when it comes to the continent. But I think, in my mind, from a tax perspective, given the upgrading of the tax systems across the board, I think it is a good thing. It is giving certainty on tax treatment of various issues. And so, from my perspective, that should make for the attraction of capital into Africa over the next 10 years and beyond. There are still some issues to be dealt with, but I believe from a tax perspective, given where we are, and the help from the, let's say, the OECD and other institutions, it is making a difference, at least as a tax advisors engaging tax authorities on behalf of our clients.
Excellent. Michael, 60 seconds.
So we see compliance, and then the immediate reaction is cost. In my experience, there may be a cost up front in terms of getting your compliance in order from a tax point of view in particular, but that cost is significantly less than taking the matter to the Supreme Court of Appeal in 5 to 10 years' time. And I've been in that boat as far as our clients are concerned. So compliance is becoming much more of an issue, and much more from a governance perspective in the context of not only the portfolio companies but the fund managers as well. So You know, you have your ducks in a row, those audit trails exist, it's a piece of cake. You don't have that audit trail in place, and it's arguably legally privileged when a lawyer gets involved with setting up your compliance processes, then it becomes very difficult.
Excellent. Shelley?
So for me, I think attracting capital, you need regulation, even if not everybody feels like they want it. But in reality, it's just balancing and making it appropriate. So the idea that actually regulation is there to protect the investor and to make sure that actually there are functions and risk management in place for the fund manager to give people confidence that actually we can grow this asset class and make sure that actually we can attract the capital that we need to essentially make the impact that the asset class is able to do.
So we've heard from three experts presenting ideas to you in around tax regulation and compliance. I agree with Michael. Compliance is not cost center. That's an inappropriate way to think about it. You will get no allocations from any asset allocator or investor who doesn't fundamentally trust what you're about to do with the pensioner money, with the provident fund money, the money that has to return lifetime benefits to the people that they're investing for. So fundamentally getting tax regulation and compliance right is, think of it the same way you think about IT systems or enterprise risk systems. You're looking for those unassisted sales if you're a company because you've built the platform and you can keep rolling out the revenue at the top line. Think about the opportunity that your private equity general partners, limited partners, and the fund have when they get the taxation, regulation, and compliance right. Please join me in thanking Enoch, Michael, and Shelley, and let's take a break.